Advice warning. The content presented in this presentation is intended for informational purposes only and provides general advice only. It does not take into account your personal objectives, financial situation, or specific needs. This information should not be the sole resource when making investment decisions. We strongly recommend you seek the advice of a financial professional. Hey there, everyone. Welcome to this week's edition of MPC Markets Bulls versus Bears. Welcome, JT.
Welcome, everyone. And busy week this week in the markets. And thanks for tuning in.
Well, it seems busy, but I think when we get up to the net changes for the week in the equity indexes, I don't think I've ever seen the Dow, the S&P, and the NASDAQ bang on flat for the week.
So it didn't matter what we chose last week. We were going to be correct anyway. Is that what you're saying?
Well, I believe that the Russell 2000 was down 0.3, so that's going to be the deciding vote. So we were 1-star bears last week. So I'm claiming a win, albeit a win. A win of the thinnest margins and of very little consequence. Or as you can see there, look. So the Dow was down 0.03. Sorry, my mistake. And the NASDAQ was down 0.3, and then the Russell was up 0.2. So sorry, I was a little bit wrong there, but by the skin of our teeth, my friend, I've got to say.
Win's a win. We'll claim it.
Well. Yeah, as long as you got good risk management on a 50-50 call, you always go all right. So
that's it. But that's always easier said than done. We've been trading a long time, so we know that it's as always when the market proves you wrong, that's actually when you earn your money. But I will say the XJO, that should have been the one we shorted because there was definitely a good move after that GD print on Wednesday. So that was a big fall, but it has recovered most of that as well over the last day and a half. So yeah, that's what I meant by it's been quite a busy week, and it's mainly been.
ASX. I mean, look at yesterday. It was up 1% yesterday, and it was still down 1.7 for the week. The banks got flogged. At one stage, there was I think it was Wednesday. Really, the pivot point was when that Apple Google antitrust ruling came down, and Google just really did pull the market up by the skull dragged it up. Essentially, it was up about 7% that week, that day. But essentially they don't have to sell off Chrome. But as you can see, the only market in the world at the moment, I've added, because I'm doing the morning podcast, I'm putting the technicals down there. I'm calling that the Takadena table because you're our resident technical analyst. And, but the Americans really, that was, the S&P and the NASDAQ were actually neutral to sell Wednesday, or even on the daily, and they've pulled very quickly back around a strong buy. But everywhere else is pretty weak. And it probably, that stronger than expected GDP number in Australia, it probably really does, maybe I wouldn't, I don't miss being a trader on nights like what tonight's going to be with payrolls, because they had really weak jobs numbers last night, ADP, which is just the weekly numbers, and they went, yay, rate cuts, and it went up. But then obviously, we had a fairly strong GDP, and they've gone, boo, no rate cuts. So look,
it's that whole bad news is good news at the moment for the equities. So that's what they're pricing in. If money's going to get cheaper, whatever the number is, we have to buy equities. So that's the mood the market's in.
Well, I mean, I wouldn't say this week it's been. Look, there's been a couple of other earnings when I've been doing the morning broadcasts. There's been a couple of earnings results here and there, but I've had to dig it. It hasn't been a layup to get the content done in the morning. You really are digging for reasons, and there was a big push in gold and silver early in the week as well. They said, and there was a lot of stuff happening for but non-correlated, there was no correlations. It was just, everything was just doing its own thing this week. And I think that's really, it's really sort of patterns you normally see into like these key numbers like payrolls is tonight. But maybe we'll get down to, it wasn't much in terms of media this week. You were on the call, weren't you?
Yeah,
At
so I
one
was on the
stage?
call. So I was on with Nathan on Wednesday. So
Yes, the
so you, so you,
MPC's perennial bear with the bull with the perennial bear. You guys agreed fairly well, I thought.
yeah. I mean, like the thing with Nathan is like he's just more very traditionally value. So he's like when things are expensive, sell it. When things are cheap, buy it. And obviously he it's a
It's
little
a
bit more
pretty good
complicated.
strategy to me.
Yeah, but so I'm actually more that because of money printing, when things get expensive, they will just get more expensive, and we're talking in actual just units of account though. So if you factor in inflation and actual purchasing power, it's not like we're actually making more money. It's just that number keeps going higher and higher. So that's
Well,
that's the market we're in.
as we were just discussing before we started the the podcast, did you say foreman for a bricklayer is getting $500,000 a year now? We're in the wrong
Yeah,
business.
yeah. So it was an actual like one of the clickbaity headlines on the AFR. I immediately saw 500,000 for laying bricks, but so I had to scroll down to the meat of the article. What the article actually said was, if there was a four-man team of brickies, the whoever's the lead brickie, I don't know what they're called, they would be on 500,000, and there would be three actual brickies on 250 each. So yeah, and that's why the cost of housing just keeps going up and up. So
So Brickworks automatic bricklayer. Remember that thing that they bought, that company they bought, that's Fast Bricks.
fast bricks, yeah. So I don't know
Yeah,
if that's
yeah, and
still going.
all of a sudden the research and development's not looking like a silly spend now.
Yeah.
Is it really? So,
Well, I
but
remember
yeah,
like seeing the prototypes of that. It's like basically just like laying tubes of toothpaste on top of each other, and that would have that 3D printing walls and things like that. So I
yeah,
actually don't know.
I reckon,
I actually don't know if
I reckon.
they've actually built any houses with that, but yeah, I remember that was a big buzz. Maybe about 3 years ago, 4 years ago.
Yeah, no, they would kept on talking about it, and I'm just like, mate, just pour concrete down it, it's like anyway. But I reckon that'd be a good job for Elon's bots, I'd say.
Oh,
Um,
oh, absolutely. I mean, like we've seen them pour coffee and wave high, so why can't they lay bricks?
yeah,
Yeah,
I suppose so.
exactly.
Um,
Yeah, so
but what
I'll
was
head
your
on to
highlight?
so ASX, so Domino's, much unloved stock on Ausbiz and here as well, but their chairman bought $5 million worth of stock, and that caused a pop in the stock. But I think that's mostly been sold off as well into. So I I think that could be the low, but it will looks like it'll take another piece of good news for at least some upside momentum here. So look, I'll look into
And
that.
another piece of good news that isn't him just buying another $5 million worth of shares. So, man, some actual fundamental news.
Exactly. So, like, either selling more pizzas or improving the recipe or something along those lines. ANZ. So they actually came out and said because of the strong GDP number, um, the RBA could be one and done. So the market's actually pricing in a 79% chance of a rate cut in November. But what ANZ is saying is like that could be it because GDP was strong. I forget the actual number, but yeah, obviously, the market's doing well. And so COG Financial Services. Reason why I chose this is that I actually had this on the call on Wednesday with Nathan. Never heard of the stock before, but I just looked at what they did. Basically, they aggregate home loans and aggregate commercial finance on equipment. It's actually, the chart looks amazing. Basically, since the April lows, it's almost doubled. I think it's up 80 to 90%. What they did was they bought a company for 40 million at 6 times multiple, and they're trading at 16. So there's that valuation uplift. And the reason why I'm actually like highlighting them is have a look at some of the other names within this space. So things like MoneyMe, Helia, and Pepper Money, AFG as well. Basically, anything to do with mortgages is on fire at the moment. So, and I've mentioned this a few times in these podcasts, is that if the companies that are in charge of actually creating money, so when these companies actually lend money out, that's actually part of money creation. So if they're doing well, that means there's more money being created, and asset prices go higher. So that's why, even though we are cautious about September and October, if the financial sort of plumbing companies are doing well, then it just means that this economy is doing well, and that's why we saw a strong GDP print.
Yeah, look, just a few points there. So the ANZ economists are, well, I'm from an interest rates background, and I'm not going to pull any punches here. They're idiots. Because basically the RBA does not target GDP. I don't think it's even in their mandate to target employment. It's inflation only. So, to turn around to you've got to be so careful with these interest rate calls, because these morons just go for a headline, and essentially they sacked an RBA governor on the back of saying, feel free to go out and get a rate. Where's the accountability for the banks that said we're going to get 3 rate cuts 3 weeks ago? And now they're like, no, it's one and done. And on the back of a GDP number, which is 3 months lagging, and is, oh my God, it is infuriating, because the worst AI model could give a better economic modelling than that. So look, if you bank with ANZ, probably move. That's just idiotic. But they're probably just that'd be someone in the bond department. They're probably giving the worst mortgage rates at the moment, and that's their excuse, because that is just idiotic. But secondly, as well, I do like the financial services where they're not holding the bag if this thing goes to hell in a handbasket either. So they're the mortgage brokers and things like that, or finance brokers where they're just getting a clip. It's a much safer way to be involved as opposed to actually being on the hook for the money themselves. But you're absolutely right. They keep going. Everyone's screaming for rate cuts, but the bottom line is that we can't have unending linear economic growth. It just doesn't happen that way. Never has happened that way. It never will happen that way. And what we missed was in the past has been at least periods of austerity where we just we pumped the brakes even just a little bit, and just we weren't, so heaven forbid we weren't making 25% on our house CAGR a year, and we weren't, and then to keep that up so you get votes in, importing a bunch of millionaires to support the property market. So it really is at some stage, we've just got to be happy. GDP is also a moronic way to measure the growth of the economy
absolutely.
anyway. That's just that's economic books from 50 years ago. But, we really do need to go back to that productivity and employment at 4%. That used to be perfect employment. And that, as the bricklayers example is a good example. No wonder a house is so expensive to build now. I was at my daughter's school breakfast this morning. They had a new sports centre that they did. It was a budget for this thing overran by $15 million on a $30 million project.
Oh, wow.
Yeah. So
I think if you miss by say 10%, 20%, but that's a 50% miss. That's amazing.
Well, yeah, maybe the PNF was doing the budgeting. I don't know, but anyway, it seemed. But look, the cost blowouts like that are just they're not uncommon on big projects, and then they turn around and say there's no inflation. Well, how is there not inflation? So, they're realistically, it's caught out companies like Domino's and things as well, where those low cost models, they're all of a sudden, what KFC had to do cabbage instead of lettuce, didn't they, at one stage? Because lettuce prices went through the roof.
Yeah, it was $11 a head of lettuce at one stage, and they had to go to cabbage.
So, but we're all getting distracted because, I mean, that could have been, like, you get Donald Trump talking about the price of eggs, for God's sake, and that's his measure of inflation. Eggs have come down. Like, no, that's not a measure of inflation. Anyway, rant over. Sorry, it's actually been a pretty good week, but it just really bugs me. The interest rate calls from these banks, particularly, got me fired up. There is no thought goes into it anymore. Someone says something off the cuff, but anyway, flip over to US stocks. So we had the Google and Apple thing this week. The antitrust thing means they're not going to have to break off Chrome. Mm-hmm. Perplexity, my favourite little AI assistant, and has replaced my Chrome.
No, I thought Grok was your favourite.
No. Grok's got its. I do love Grok. Grok's got it. Perplexity has completely replaced Chrome for me on my desktop, on my and on my phone. I don't even open Chrome anymore unless I need a password for something or I've got to log into an account. But they actually bid $27 billion for Chrome just in case Google had it ruled against them. Mm-hmm. And look, but essentially they get to keep the status quo. I would imagine that there's that there'll be an appeal because lawyers are lawyers. But that actually really benefited Apple because the Apple's relationship with Google as well could continue. So and I mean, they're making so much money. You can't tell me that it probably wouldn't. It would benefit if things got broken up. But like I say, I think they've just fought this big, long-winded battle. Europe's severely got the shits with them with all that Mag 7 and they just keep contesting. I think Donald Trump's saving them a little bit, but that was the turning point of the week. Like they literally carried the index higher, and then Salesforce was a really disappointing result this week. And interestingly, they flagged in their commentary that they've seen decrease their outlook for the next quarter, and they commented that large enterprises are scaling back their AI spend, and I do tend to focus on Salesforce because them and ServiceNow really they're the pointy end of the sword with agentic AI services, which is the next phase, and they've got really good products, but they were ahead of their time. Salesforce has had agentic stuff for ages, and ServiceNow's caught up a little bit, but they found the customers aren't using them. They're just not using them. And so then they got criticised for their R&D spend, and look, they're so obviously being a little bit early, and now the agentic thing's kind of caught up, and I think they're probably one of the best guides. I've found their commentary from their earnings reports have been some of the best guides on spending patterns for AI, and they're saying that economic uncertainty and their IT spending and AI spending is being significantly scaled back. So that to me is a touch concerning, but I think we tend to focus on the Mag 7 and things, but I think that spending is it's getting spent at the data center level and the infrastructure level, but I don't really think it's being at a company level. CEOs want AI and they want efficiency, but they don't know what they want, and that happened all through the the 01.
Yeah, you posted that good cartoon on Twitter. Like basically,
yes.
What do we want?
When do we want it?
Now. What do we want? We don't know. When do we want it? Now.
And that should be a good campaign for ServiceNow.
And last one was Broadcom. So Broadcom came out with results last night. Or was it this morning? I think it's
this morning they beat, and
and they're matching above.
They rallied late.
Yeah, and they're matching above the recent highs. So
up about 6%. But directly after the earnings result, because I was surprised that it hadn't moved at all, and that was about 7:30 because I had Father's Day at school duties, so I recorded early this morning. But it rallied half an hour after the earnings results came out. So they obviously found something in there that they really liked. Google apparently is working. There's some mystery customer. Richie Nader was saying about 10 billion. I've got a sneaking suspicion it might be Google. Apparently they're working on some chip that's going to. There's rumours floating around that it might compete with Nvidia, but I mean we've heard that before, right?
We had Barber this week. Like they came out with a chip that was going to rival with Nvidia as well. And
no, that wasn't the case.
Wasn't it? Okay.
It doesn't rival the high end, but it does a lot of the grunt work. So the Nvidia chips are being used as a bit of a one size fits all, just like But these specialty chips that are coming through are taking huge amounts of workload pressure off the black or the Nvidia chips. So what it would effectively the Barber chips would do is reduce the Nvidia workloads significantly. They can take all of those like middle to lower tasks just completely out, and then your Nvidia box or your server box.
So sounds like AI itself. Like basically, you give the lower, easy, repetitive tasks to AI. Well, that's what we're trying to do in our business.
Yeah, and all the high level tasks. So and I saw a really impressive thing from Micron this week as well, which in memory, and they will now deliver you as a service the entire server rack pre-built with everything in it, the cooling, the whole works. You literally just you plonk it in and you plug it in from the side, and the whole thing's just like pre-custom made. There's no setup, which was like, I'm just nerding out a little bit here. It's not really relevant to investing. Sorry, folks. But it was just really cool to see they just literally walked in, dropped it in, and it was just like everything was ready to go. So it means that they're doing all these side deals with all these components makers. And that was one of the things that we focused on in the webinar earlier in the week for hyperscaling AI is that all of these heat sensors and pressure sensors and humidity sensors and et cetera, and power monitoring, they're going to start selling a hell of a lot of that stuff pretty soon. So,
all right,
cool. Yeah, but Broadcom pretty good, and they're a distant second. It's kind of like the silver medalist who lost to Usain Bolt, but they're miles behind. But don't even know his name. But they're the next viable alternative, I suppose. But yeah, so as you can see here, the Apple and Google clear winners.
Yep, that's Thursday to Thursday, obviously. So
yeah, it's Thursday. Thursday to Thursday. Can't work out what happened at Amazon. I think it was slightly better than expected, maybe consumer numbers, but it was up 4% overnight. There was no news I could see. So literally, if you flipped it, it was the opposite up until about Wednesday, although Nvidia's been under pressure all week. I think the market's starting to realise that people are catching up. They're not going to have it all to themselves. But look, I'd still back them. I'm hoping they just get belted so we can buy some more personally, because I think people are underestimating Jensen's that ecosystem, and that networking is going to end up being, he reckons, more revenue than the chips. So he's thought ahead, the big fella, and kudos to him.
Yeah, and one that I'd like to highlight is Netflix. So shout out to any parents out there who have been invaded by the K-pop soundtrack, but Netflix has bottomed out and looks like I think it's going to head back to the highs from here. So I might have a chat to Richard about maybe choosing an entry for clients, but that is one that's on my highlight reel. And Mark, even though he has a lot of kids, his kids haven't listened to the soundtrack yet, but I assure you it's coming.
Oh, look, I mean, we've been through Frozen. I had to ban Frozen. Which was the music was written by AI on that one,
but just saying, these songs are even catchier than Frozen.
Oh my god!
Exactly.
I hope that I never hear any of them. Look, I promised the bear suit, and I'm look, I'm definitely not on the buy side on anything, because I just really value having some cash just in case. I'm not as convinced on the September weakness now, only because everyone's talking about it. I don't mind an occasional pundit here and there, but like it was like a parade of like from the the second or third. It was
Yeah,
ridiculous. Like everyone was talking about it.
Yeah, the first down day of the month, it was like, oh, it's September,
Oh yeah.
and as you said, like when everyone's doing the similar thing, the markets just don't head that way. It's just not how.
The
That's not
moment
how it works.
the moment that Google and Apple thing came out, I was just like, oh no, I should have gone, because I nearly went bullish last week on the pod, and I was like, oh, I should have gone bullish. This is short squeeze city right now, and I reckon. I reckon that despite the fact we ended up flat, like it was, and it's really only been a 4-day week in the States. Then Congress hasn't really come back yet, but yeah, I think it's still in bull. I don't think it's going to happen. And the response last night to the weakness in those job numbers, I mean, apart from the fact that it makes no logical sense, is essentially that I think tonight's going to be really difficult. Like I traded payrolls numbers. I traded interest rate movements and equity index movements as a prop trader for 20 years. I think I missed 2 payrolls, and I was on holidays in 20 years. This will be one of the hardest ones. Whatever the first move is, it probably ends up going the other way. But God knows what the market will take it as. Like if it's bang on expectations, I would say it'll probably rally. If it's or slightly stronger, say 100,000. So they're expecting 73. I think I've got here we are here. Sorry, didn't flick the slide over. So as you can see, it's trending down, right? Like, I mean, it's a classic downtrend there. And one of the rights there is the revisions. So since the Bureau of Labour and Statistics Commissioner, Erica, and I can't pronounce her last name, so I'm not going to try, got fired. Trump's trying to get this E.J. Antonian, who was at the Capitol riots. I don't think he's confirmed yet, but I would assume that everyone at the BLS knows what number Trump wants, and it's not good. But look, I would say, that we've already had the move about optimism on rate cuts. Now it's 97%. So it was 99%. It's been down to, I think it's been down to like 70%, then back up again to 97. Like, I think we will get another rate cut because the Fed governors, one of them's been fired. They're all getting investigated secretly by Trump. It's not so secret now, but they've actually found that out. I think they're just going to give him a rate cut to shut him up. But so they're not copping crap in the press all the time. Remember, these guys are just economists. They're not bloody reality TV show stars like he is. But these downward revisions, I mean, whether that gets front loaded, but 73,000, it was last month, 75,000 expected this month. I think you've mentioned the stat before. It was about 120,000 to keep up with the migration. But now they've closed the wall. Maybe it's not. But and then unemployment rate from 4.2 is expected to go to 4.3. So, we haven't had a negative payrolls number since December 2020. That's my monthly cue.
We haven't had one since we started the podcast either.
Well, no, but I've said it nearly every month. So, but a negative number would shock the market. But anything between 50 and 110 will probably see the bloody thing rally. And anything way above will probably see the market come off because I'll take the rate cuts off the table. So I'm glad I'm not trading anymore. Let me put it that way. So I reckon there'll be traps everywhere.
So just as a thought exercise, like let's just put your prop trading days sort of hat back on. What were you trading? I'd just be curious. Like, were you trading the bill strips, or were you trading the minis, or what would you position? How would you position them?
So, all of the above.
Okay.
So I used to trade a fair bit of oil. I had an algorithmic system in oil, until they moved my server and the hit rate got destroyed. That's where it sort of becomes a bit of an arms race, and one of the reasons I left is I just didn't want overheads of hundreds of thousands of dollars a month to have my server 6 millimeters closer. But mainly I was interest rates. So I would trade credit, what's called credit spreads traditionally, so bank bills or corporate debt versus government debt. And so, that was the thing that blew up in the GFC. So that was a fun couple of years. I didn't spend a lot of time in front of the screen, but survived, still had profitable years all through that period. You just couldn't market. And then I'd trade equity indexes broadly overall, but and look, the occasional commodity, but mainly the S&P. Didn't really trade NASDAQ much. In hindsight, now that I've been in equities for a period, if I could go back in time, I'd tap myself on the shoulder and say, hey, idiot, you don't know you have no idea what you're doing here. Get out of the way. Stop shorting so much. But, I'd probably actually, firstly, it's always the checklist with the time machine. First thing, you go back and kill Hitler. Second thing, you go back and tell myself to buy Palantir and Nvidia last year, so or Microsoft back in the early, at the depths of. But that'd be one of the bits of advice, because it sort of underestimated a lot of nuances about particularly the Australian market. I saw so many traders see the S&P go higher and then just turn around and go, oh, well, the SPY's got to go up. And it's like, well, no, because one of them is a tech index and one of them is a bank and resources. And if they, I watched some guys blow some money on that trade.
Oh, yeah.
It's called the Widowmaker. Short the S&P and long the Aussie.
Yeah, long spot. That's the one.
No.
What are some of the other Widowmaker trades? I know the short banks. Aussie properties too expensive, so we got to short the banks. That's the other one. And JGBs, they can't go below zero. that's a Widowmaker trade as well that I've been around to witness.
Oh, look, but that was a consistent, the old adage of boiling a frog in a pot. That S&P SPY trade just used to boil people slowly. It was horrible. And I only ever did it on super extreme moves, but when someone out of Europe had come in and smashed the SPY because they didn't realise that we weren't liquid at nights and it was in the middle of the night.
All right. So on to commodities. So the main thing this week is gold and silver both made new highs this week. Copper's bounced off its lows. Even platinum and palladium, they both pulled back and started the rally. And the great thing that I found is GDX and SIL, which is the gold miners and silver miners. They're all just rallying and doing really, really well. Interesting to note that Newmont's one of the strongest stocks on the S&P this year, along with Palantir. And so I think, there's...
Yes, and you must have seen my tweet. It's MPC owns both. But Newmont's about to... I put up Newmont's going to go to $100, and shout out to, to the boys on Twitter that I converse with quite a bit. And I just got the laughing, crying face emoji on that one. But we've been on Newmont for over a year. We flick back and forth. I think we're in Northern Star at the moment. But Saints, we've ended up making an extra 25 to, nearly an extra 40-odd% going the relative value between the two. But Newmont's taken off now. And I always said it's the only gold stock in the S&P 500.
Yeah, that's
a big thing.
That's why it's outperformed Australia. Like, it's basically, if you're in America and you're like, oh, well, I'm just going to buy some gold miners. I'm like, oh, there's only one there. So, yeah, that's where the money's going. So that's why it's outperformed a lot of the gold stocks here in Australia. But
$114 now.
Yeah, it's been an amazing move.
I was kind of half kidding when I said 100. We were buying it at 40, 45, I think. And I think we were in and out a couple of times, but I mean, we've outperformed what that move is overall, being back and forth with Northern Star. But Well, and then not to mention the litany of successes in your recommendations in the alpha with the gold stocks as well. But as you said, JT, play the hits. No one wants to hear the new stuff. If we're making money in gold stock, keep recommending it.
Yeah, exactly right. So one thing I was listening to another podcast, and I keep getting asked, isn't gold and silver too high? Can it go any further? And so my response with that is, the only thing that can sort of change this trend is if the governments start being responsible with their money. And the other point I want to make is,
which I have stolen that line and used it on not only on the phone but social media. The response has been general, like at almost 100% hit rate. Laughter. It's like, that's never going to happen. I'm like, well, you just answered your question.
Yeah, and that's exactly right. And that's why I've been, I remember turning around and starting to go, well, look, if I'm going to go on Ausbiz regularly, I might as well just keep a thematic going through. And this was when gold was just under $2,000. And I just remember...
Yeah, your call to 2,700 was like, everyone was like, no way. We're at 3,600.
Yeah, exactly right. But and as I said, it's still one of the easier trades to hold on to because, the government's just, Elon tried. Elon tried to be responsible with the government funds. Doge failed, and then Trump's come out with the big beautiful bill, and that's why, asset prices just have to go higher.
Well, Doge didn't fail. It's just Elon just basically. Trump just undid all his work in one big, beautiful, crappy tax bill. So
right. And Elon did his part, but then let's just say Trump didn't do his part, and and all boils down to is that they're stuck. They're stuck. They've got all these liabilities, and they just have to print. And it's just a matter of, are they going to do it in a stealth way? Or is it going to be more pronounced like a QE situation where they go, well, we're just going to do yield curve control, or we're just going to buy, fix the long end, something along those lines. But it'll be interesting to see how it plays out. But that's, you can see it in the price action of gold and silver, and even Bitcoin.
Yeah, look, I mean, I think I may have said this on previous pods, but look, Trump. If you step back, look at the broader picture. The only thing that moves the needle on the debt is interest rates down by 2% or 1.5 to 2%, which is $400 or $500 billion annually off the interest payments. There's $7 or $9 trillion that needs to be refinanced. Things bounce back. He wants rates lower, but look, and I guess he will be more than happy for there to be a short, sharp recession as soon as humanly possible. Really, and you've said this, since he got elected back in November, JT. Like he'll get the pain out of the way first, and then, but he'll basically the best way, instead of stacking the Fed, the best way is to just do some crappy policies like tariffs that slow the economy down, get the rates down while you're actually pulling in some revenue. And then, but I don't think the economy is nosediving quick enough for him because I think it's. Yeah. And then once that's done, it will be print, baby, print. And I like, and then this. I think the stock market will then have because of the money supply going up. Those brickies you'll be on $1 million a year in about 5 years' time. So your money will be worth nothing. But hence why we're buying gold and silver. But the and Bitcoin. But the I'll come back to another point. But that it just means the stock market's going to go higher. It just will, and that's not. But you've got that wealth erosion that's happening is just it's not good for generally for economies. So I am like I've always been after watching the financial system stand on the edge of a cliff in 2008, 2009. I've always been a bit of a fan of Bitcoin, just on the basis that governments don't.
Well, they can't print Bitcoin. That's the whole
they can't. Yeah, they can't print it.
They can't print it, and because of the network effect, it's going to stick around. Just conscious of time. Let's move on to the. Oh, okay.
Just one quick point. They did announce this week that Trump's looking at converting some of the gold reserves to Bitcoin in the US. It was an announcement that he made last night.
Oh, okay, yeah. Here we go. Trade of the week.
Yep, gold and silver miners, which we've talked to death today anyway, so we don't really need to cover this too much. This is structured investment that we did last year, almost 12 months. We've got about 12 days to go. So it's an enhanced growth strategy. It's part of our structured investments, wholesale professional investors only. But essentially what we did last year, and I'll give you the example, we're up 203% ROI on that trade. But we had a pair, gold and silver, and we just went with the gold price and the silver price ETFs in the US. They go as a pair, and then essentially we got 10-to-1 leverage on it. And once that first 10% was out of the way, you've recouped the cost of the strategy, because that's all you can lose. Essentially, you can't go. So if gold and silver were to halve, for instance, you can only lose that 10% on a notional. But if it rallies, you get all the benefit of having it. So this one's a touch more expensive. It's around the $13,000 cash outlay for $100,000 notional exposure. For those of you who don't know what notional is, go and Perplexity it. But this time we are going to use gold miners. Silver, still very happy to use this, and the silver miners won't see the benefit of margin expansion like the gold miners are now, probably for 12 more months. But as you can see there on the left-hand chart, gold miners making record margins. The top 10 holdings in GDX, which is the same as here as it is in the US. We're using the US version because the average all-in sustaining cost is $1,307. Newmont's the biggest holding in there, and gold's at $3,600. So,
wow. As I say, printing cash. And in this case, printing gold.
Yeah, exactly. And then gold-silver ratio as well. The 50-year average, less than sort of 7 months in history has in the last 50 years, there's only 7 months where silver's been this cheap in the last 50 years against gold. The gold-silver ratio is simply how many ounces of silver make up an ounce of gold in terms of price, and it's somewhere in the 80 to 90 region at the moment. Those two periods, you can see on the chart there, those two periods make up 5 of those 7 months, and that was 2011 and just recently. To get back to the 50-year average at 60 to 1, silver gets back to $60. So I reckon there's a 50% rally in it in the next 12 months. If you get it to overextend, which markets nearly always do these days, I'm going to call it potentially anywhere from 70 to 100% on a squeeze at some stage in the next 12 months. So, get your silver, but this is a great way to represent it, because you get go and spend that other 87,000 on something else, some fixed coupon notes or some cash or whatever you want to do. But it's super capital efficient. You basically get around about the same result to the upside, but you're much better off to the downside. But it does really outpace. You're not going to go and spend $100,000 on gold miners. Why would you do that when you can just spend $13,000 and get roughly the same exposure? So, if you've got any interest, check our socials. You just click on it. You can download the investment guide. That'll close early next week. But yeah, let me put it this way: the people that did it last year was our first enhanced growth. For every $10,000 they put down, they're getting $30,000 back at the moment. And that's with that move last night to the downside. And we've still got 15 days to go. So go silver.
Yep, nice.
So fear and greed.
So it was actually 53 last week, and it's back down to 52. And that kind of tells me that, this market's not greedy enough to sell off. So what's your prediction for next week there, Mark? Knowing that we're bang on too. So
I was going to be I was going to be 1,000-star bear this week, but I got to say that the reaction of that ADP number just freaked me out a little bit. But yeah, look, whether it happens this month or next month, that one of those payrolls numbers is going to be an absolute shocker. So, I'm bearish, but I'm a cautious bear. Last week I would have said I'd be short to the eyeballs leading into this, and then I just watched some of financial markets' worst pundits come out and just normally I get ridiculed for the seasonal weakness thing. I'm the only person sort of saying it, and I don't know. Maybe I'm uncomfortable that people are agreeing with me. But I agree with you, mate. I think there's a real risk this runs next week. I think payroll can be the wrecking ball, so I'm going to go bearish. But I tell you what, if we have an up night tonight, trading mentality, I'd be stop reversing because I think you're right. We've got to get to greedy territory first. Credit spreads are still super, super low as well, which means that there's just cheap money flowing around, even if you've got a shitty credit rating. So, I mean,
so the only thing that caused the market to actually fall was the long end of the JGBs and the gilts. So they've fallen back a little bit. So unless they spike up again, it's going to be hard to see these things sell off. And as you said, the reaction to the ADP number. So with that, I will go a 1-star bear because I'm talking my book. I actually would like the S&P to fall for some of our structured products. So a 1-star bear for next week.
Yeah, look, I don't see myself. I think there is risk to the upside, but this seasonal week. We need to. It almost these days the market needs to be lulled into a false sense of security, like September weakness isn't going to happen, and then that's when it's going to come get you. And look at that EJ Antonio hasn't been confirmed yet at the BLS, so I'm not entirely sure, whether Trump will be able to just dictate the number. So look, I'm pretty wary, but if it doesn't happen in the next 2 weeks, it's going to happen in the next 6 weeks. I'm very firm in my call that this thing is going to go close to revisiting those April lows at some stage in the next 2 months, because I never in 30 years have even leading into the GFC. The market has never been this irrational. I've never seen so many metrics pointing to being overvalued. I've never seen so much safe haven demand. I've never seen and so much geopolitical turmoil, etc. We'd already be through April lows with what Trump's done. We would never have recovered in the first place. So, it's got to come home to roost at some stage, and seasonality, the algos will go with it, and I think that's but if it happens, I can't see it happening in that November, December, January period, because it just seems to just float higher there all the time. So we just remember as well, we've got a government shutdown vote in the next week and a bit as well. So that service will start up soon.
Okay, cool. Well, either way, let's wrap it up.
Indeed.
So been a long one. So thank you for listening, and talk soon.
No worries. Cheers, mate.